So let's talk about the drop in bond yields, the flatter yield curve, and whether this is what the Fed wants. Joining me are Kumar, the president of Kumar Global Strategies, and Art Hogan, the chief market strategist at National Securities. Welcome to both of you. Sri, I'll begin with you because I think, Michelle just spoke of a divided Fed. I think if you were on the Fed, you'd be on the side of the hawks. So, what changed, Sri? Because I think for years we were talking to you about interest rates potentially plunging and going, 10-year almost going to zero. Now your concern is on, the flip side of things, right?
Right. Kelly, for so many years, I was looking at the bond yields going down because I didn't see inflation pick up despite the Trump tax cuts, and I didn't expect growth to pick up to a significant extent. And that was going against the consensus. That's how it worked out with the 10-year yield going below 2%, then going well below even 150. What changed was at the beginning of this year when we had the Senate runoff elections for Georgia, giving all three branches of government in the Democratic hands with a lot of increase in spending coming. At the same time, you have a close working relationship between Chairman Powell and Treasury Secretary Yellen, which again is going to make for a significant monetary expansion. So price increases go from the transitory phase to a permanent phase, Kelly, only with the oxygen provided to them by continued money growth, and that is going to come. It is not going to go away anytime soon. Second, the Fed has no more foresight into whether inflation is transitory or permanent than those of us have on the market side, and they are looking for a much delayed cutback, if at all. And why are bond yields falling? Because for the last 10 or 11 years, we have had a very benign inflation environment. For the last 3 decades, we have had a bond rally. So the market says they are not going to give up on that. They believe in the chairman. Okay. He will see them through. And that's the problem here.
Art, why do you think bond yields are acting the way that they are? And to put it differently for investors, we were speaking yesterday about a CNBC survey that showed that financials are one of the preferred investments for the back half of the year. But in there is this expectation that interest rates are going to rise. And when people come on, I think it was Goldman or Morgan Stanley the other day that said, yes, we like the financials. We think rates are going up to 2% and so forth. Well, there's so much that depends on whether that actually is true this time or not. Why do you think yields are where they are?
I think a couple of reasons. I think if you look at the demographic of the U.S. population, you've got a lot of people that are forced into the low-yielding U.S. 10-year, right? So the fixed income market is driven by the second largest population in the United States. Secondly, if you look at the end of the first quarter, entering the second quarter, Japan actually became a net buyer of U.S. Treasuries after being a net seller for the better part of 6 months. So I think that's another dynamic that's going in. And then I also think it's the Fed's communication strategies, talking about the fact that they're eventually going to get to a place where they're going to start tapering. I think Michelle was right. They probably announced this in September. They'd probably start executing at the end of the year. But remember, if that balance sheet, let's say they complete this taper in a 12-month period, that balance sheet's going to remain the same size for a while. So they'll still be active in the open market, keeping the balance sheet the same size, reinvesting the runoff. And I think that's what's sort of kept the action in the U.S. 10-year at bay. And I also think it is because we're starting to see some rollover in commodity prices, right? When you start being hyper concerned about inflation and then lumber all of a sudden is down 47% from its peak and you're seeing a rollover in copper, you're seeing a rollover in iron ore. I think that's that supply response we've been waiting for. So I think that the same thing will be true for things like wages. I think that if you look at the month-over-month numbers from today's report, you saw there's deceleration in that month-over-month increase in wages, and I think that continues.
Art, you're almost kind of making the argument for the growth trade, right? The value trade is wages are going to go up, the commodity prices are going up, financials are going to go up. You like financials, you like energy, you like industrials and materials. Why do you like all of these sectors, even if you're describing wage pressures and some of these inflation dynamics as basically transitory?
That's such a great question, Kelly. I think you can have both, right? We would like to have a barbell approach. We want you to have growth on one side of that. We want you to express that in thematic ideas like 5G and cloud computing, cloud security. On the other side of that, we want you to have exposure to cyclicals because we definitely think the economy is improving. We think the cyclicality will still be with us throughout the course of the year. If you went back to the March 2020 lows of last year and then track both growth and cyclicality, they're almost exactly the same. They've just had 6 months rotations, right? The first 6 months was all about growth. The next 6 months was all about cyclicality as we started to get better news on vaccines and technology got expensive. This year's been a mirror image of that. We're seeing the same kind of action. We have these rotations, and I think that will continue for the year. So you want to stay balanced.
Shepard Smith here. Thanks for watching CNBC on YouTube.